Good afternoon, this is Mike Bertelsen, the Bear Market Investor, with the market update for January 25th, 2011. We're here looking at the Volatility Index in the daily time frame. Now, in the last videos that I made, I was talking about, with regard to the VIX here, that I did believe the market was likely to see an increase in volatility in that coming week. Unfortunately, we didn't have a false breakout here. In the volatility index here, as you can see with this particular line. Now, what these blue lines are here, just to give you a little background, is what we call the Fibonacci Fan. It's not a tool that a lot of people understand, but in essence, all I've drawn right here is this particular line right here, which is the initial wedge that we broke out of in terms of volatility here in the month of August. And after that, we have the 38.2% retracement, the 61.8% retracement, and then the 78.6% retracement, also coming in at this declining area of resistance in the VIX. Now, we had a false breakout, as I noted here. We saw a pullback here, an attempt to break out. We came back below, testing this horizontal level of support before having a surge in volatility, which is, of course, what led the market lower just very recently here. And then now we're starting to see a little bit of weakness here in the VIX, suggesting that we may actually see a little bit more to the downside. Now, just looking at the candlesticks, it does look like we're probably going to attempt to come back to this, at least this ascending area of support here in white before perhaps another surge in volatility. Now, if we actually do come back down to this horizontal level and put in a triple bottom, that's going to be something interesting to watch. The S&P has a few options here. We'll get into that in a moment. But I am still looking for a surge in volatility that will eventually lead us up to these upper boundaries, upper areas of resistance here in the volatility index. And that should produce a correction, at least a correction in the market somewhere between what we saw in November there and what we saw in the April 2010 sell-off. Obviously, we have some restrictions here, but we don't have as much restriction as we had back in November here, because we had to contend with this 61.8% Fibonacci on the Fibonacci Fan. So, again, I do probably expect that the market will actually move a little bit higher here. We'll jump into that S&P chart shortly, but that should lead to little lower levels, at least in the volatility index. Now, I'm still expecting, regardless, that this level of support here in the volatility index is going to hold up. Should we actually penetrate this rising area of support and come down to this horizontal level of support, that we probably, even if we do that, we may see an attempted break of that before coming back and getting some sort of reversal candlestick. But time will tell. We'll probably figure this out in the next few days here, probably this week, what the volatility index is actually going to do. Certainly tomorrow is an option for at least reaching this ascending area of support before attempting to bounce and move on higher. Now, again, if you watch the prior videos where I was talking about the volatility index and the sentiment surveys, none of that has really changed too much. The market isn't quite as bullish, as it was before, but that bullishness really hasn't faded that much either. So, the market is at extreme levels of complacency. There is ample reason to believe that the market is going to experience a sell-off in the near future, and we're just going to have to wait and see what the market gives us. Now, as I had mentioned as well, I could see this, this whole volatility index here not necessarily even breaking out until perhaps as late as July of 2011. If we actually got a surge up to these upper boundaries right here before coming back down and attempting another breakout of that 78.6% retracement and the longer term declining area of resistance, at that point I expect the market to crash. But until we actually see a breakout here, I'm not expecting that the market probably is going to crash. We have at least a correction ahead of us, and I would be surprised if we did not get that at least, because there's certainly a lot of room here for the volatility index to move up before we actually hit any key levels of resistance. Certainly we have some horizontal levels of resistance coming in here at the 24 level, but a surge to that is going to cause at least a decent sized correction in the market, similar to what we saw in November, but I still suspect that we're going to move on to higher levels than that. That could get the bears revved up here and put on a little bit of a short squeeze. Even that may lead the S&P into at least a good counter trend rally if indeed the market is in process of topping here. If it is going to hold out, again, I'm expecting that it could hold out as late as July, middle of the year, June, July-ish, before we see that extreme surge in volatility from the breakout of these areas of resistance. So going ahead and jumping in to the S&P 500. I'm going to show you the 30-minute time frame here. Now this is what we've been doing here over the course of the better half of the month. Now I was calling for a top, I believed, at around these levels right here. We did have that additional surge there. It still counts well. In that we could have actually had a top there if this is indeed wave 5 of C in terms of Elliott wave, suggesting that the March 2009 lows up until this point was in fact the end of the counter trend rally, and the market will resume a larger bear market. But I still suspect, just based on what I'm seeing there in the volatility index, that the market may at least hold up, if not even move higher after a correction has taken place. So there are certainly ways of reading this decline right here that we saw as being a 5-wave decline. However, I'm also starting to question whether or not we may even have a some sort of triangle or 4th wave triangle, and that we haven't even yet experienced the 5th of the 5th wave. So there are a number of options here left. I did open up the rising wedge pattern a little bit. I had previously had it drawn right here, and we had bumped through that slightly before closing back beneath it, but just the fact that we did push above it suggests that I should probably redraw this. If this was indeed a 5-wave push here in wave C, this is probably a better way of drawing that rising wedge pattern anyway, suggesting that there could be a little more upside here left before we conclude. Now, other areas of resistance that we could be looking for are in the 1300 to 1315 area. That would work out well as even moving up to this area right here, the 78.6%, and this longer term area of resistance here in magenta. That is an area that I'm eyeballing here. This is more than a decade long of support and resistance at that particular level, as was this. It just depended on whether you were looking at in arithmetic or logarithmic scaling. So that said, this is probably the upper potential for the market here at around 1379-ish. If we do actually see a push to that level, I am looking for the market to at that point reverse. I do not honestly believe there is any likelihood that we would exceed those levels unless it was, again, some sort of shooting star formation or something like that, where we had a brief penetration of that level, perhaps even to test this, or at least try to attempt to test this upper green boundary here of the larger channel that we've been in, but I think that won't even be successful. We'll probably be fairly well contained underneath 1400. So those are the short and intermediate term options here for the market as far as I see it now. Longer term, I do expect that we're going to see a large crash in the market. Now, long term, as far as what a crash amounts to, we're going to have to wait and see. There's certainly extremely credible evidence as far as technical analysis is concerned, and particularly an Elliott wave, to suggest that we will actually break the March 2009 lows and move well beyond that, as well as just looking at the longer term double top in the S&P 500. If we actually move out here to the monthly chart, I can show you exactly what I mean here. This is a very bearish pattern. This actually shows you what I'm talking about with the longer term area of resistance here at this level. If I were to even switch this into arithmetic scaling, you can see at this point that these two slopes match up exactly and perfectly with these bottoms, as well as the other in logarithmic scaling. We did actually push through that. I was thinking that there was a possibility once we crested that April 2010 peak that we were going to move on higher. This did act as a boundary here, but the market did push through it. So then we are either on to slightly higher levels than we are right now, perhaps at 1300 to 1315 area, all the way up to the 1379 area, the 78.6% retracement, and this magenta line right here. If we actually see that, do expect the market to crash after that. If the market does in fact penetrate those levels and move on to much higher levels, even if it is below this last top here, but above the 78.6%, I'm starting to question at that point whether the market is in fact just going to go ahead and move beyond that. Usually once you see corrections move past the 78.6% retracement, it is less likely that it is a correction at that point. I mean, you have to have some pretty credible reasons to suggest that it is in fact a correction, but I do believe that's what this is. As you can see, long term here, this is a pretty clear looking ABC correction. A longer term double top is either that this is the crest of a 5-wave push here, and that we should see a very large correction here in the market that should lead to substantially lower levels, or the top was actually back here and we're in fact in some sort of expanded flat or flat correction, depending on how you want to look at it there. So certainly if you look at the S&P in terms of gold, or priced in gold, we did in fact top back here in 2000. But as far as actual dollar value, we really peaked here in 2007. So those are the short, intermediate, and long-term options for the market and what I'm expecting here. Certainly, I do not expect that the market should hold up anywhere beyond mid-year, if it even gets that far.